Right now, as we watch the market move in real time, the stock price for Supermicro Computer Inc., ticker symbol SMCI, is trading at precisely $33.30, showing an intraday gain of $0.82, or roughly 2.52% in the green as of this morning's session. Seeing green on the screen for a stock that has been battered so relentlessly over the last few months might feel like a signal that the worst is over, a sign that the bottom is in and the recovery is beginning. That is the expectation, that a company central to the artificial intelligence infrastructure build-out, trading at a single-digit forward price-to-earnings multiple, is a screaming buy that the market has simply misunderstood. However, the reality is far more complex and significantly more dangerous. What we are witnessing today is not necessarily a recovery based on fundamentals, but rather a volatility compression in a stock that has effectively become a binary gamble. The movement we see on the chart right now is happening in the shadow of one of the most severe corporate governance crises we have seen in the technology sector in years. While the price ticks up 2%, the structural integrity of the company's financial reporting remains in question, and the clock is ticking loudly on a potential delisting from the Nasdaq exchange. Most investors are looking at the price action thinking this is a simple buy-the-dip opportunity on a high-growth AI stock, similar to how one might approach a pullback in Nvidia stock or even a correction in Tesla stock. But the situation here is fundamentally different because the risk is not about slower growth or margin compression. The risk is about whether the financial statements we are looking at can be trusted at all. To understand why this price level of $33.30 is so critical, we have to look beyond the daily fluctuations and confront the elephant in the room: the resignation of Ernst & Young as the company's auditor. When an auditor resigns, it is never a good sign, but the specific language used by EY in their departure was alarming. They stated they could no longer rely on the representations of management and the audit committee. In the world of corporate finance, that is the equivalent of a nuclear detonation. It suggests a breakdown in trust that goes much deeper than a disagreement over how to depreciate a server rack or recognize revenue from a specific contract. This development has frozen institutional capital. Big firms, the kind that use Fidelity Wealth Management or allocate billions through Interactive Brokers trading desks, have compliance rules that often strictly forbid them from holding shares in companies with such severe auditor flags. This institutional exodus explains why the stock collapsed from its highs of over $100 to where we sit today. The retail investor, perhaps trading on the Robinhood app or managing a portfolio through SoFi Investing, sees the price drop and thinks bargain, while the institutional investor sees unquantifiable risk. This divergence creates the tension we are seeing in the price action right now. The stock is trying to find a floor, but the ceiling is capped by the massive uncertainty regarding the filing of their 10K annual report. This brings us to the immediate mechanical risk, the Nasdaq non-compliance letter. Supermicro Computer has failed to file their annual financial report on time, and they are currently operating under a grace period to submit a plan to regain compliance. If they fail to satisfy the Nasdaq's requirements, the stock faces delisting. This would mean SMCI would be kicked off the major exchange and relegated to the over-the-counter markets, or pink sheets. For a company that was recently added to the S&P 500, this would be a humiliating and value-destructive event. It would force index funds, think of the massive passive flows from Fidelity ETFs or even the automated allocations in Schwab Intelligent portfolios, to forced sell their positions. That is the sell pressure cliff that bears are betting on. However, the counter-narrative, and the reason we are seeing buyers step in at $33, is the belief that the business itself is too strong to fail. Supermicro is not a vaporware company. They are a tangible leader in high-performance server solutions, specifically in the niche of direct liquid cooling, or DLC. Let's pause and look at what this company actually does, because amidst the accounting drama, the actual business is often forgotten. Supermicro builds the physical infrastructure that powers the AI boom. When Nvidia ships its latest Blackwell or Hopper chips, they need to be slotted into server racks that can handle immense amounts of electricity and, consequently, generate immense amounts of heat. Traditional air cooling, fans blowing air over chips, is reaching its physical limits. You simply cannot cool the newest generation of AI clusters efficiently with just air. This is where Supermicro's expertise in liquid cooling becomes a massive competitive moat. They manufacture server racks that circulate liquid coolant directly to the hottest components, allowing data centers to run denser, faster, and more efficient operations. This technology is critical for the hyperscalers, the Googles, Metas, and Microsofts of the world. The expectation earlier this year was that Supermicro had a lock on this market and would ride Nvidia's coattails to a trillion-dollar valuation. The reality, however, has been marred not just by the accounting issues, but by reports that Nvidia may be diversifying their supply chain. There's chatter in the supply chain that orders are being shifted to competitors like Dell and Hewlett-Packard Enterprise to reduce reliance on Supermicro during this turbulent period. If the accounting scandal causes them to lose their privileged status as a first-to-market partner with Nvidia, the value proposition of the stock changes dramatically. For the individual investors sitting at home, perhaps using Fidelity brokerage services or checking their Robinhood stock trading account, the question is how to handicap this risk. Is this a $50 stock masquerading as a $30 stock? Or is it a $10 stock waiting for the other shoe to drop? The volatility here is extreme. We have seen days with 10 or 15% moves, which makes it a favorite for day traders on the Interactive Brokers platform or those using SoFi Active Investing to capture short-term swings. But for the long-term holder, this is a test of nerves. The comparison to Tesla stock is apt here, not in terms of business model, but in terms of sentiment. There were times when Tesla faced massive skepticism about its accounting and production targets, and those who held on were rewarded. However, there were also companies like Enron or Wirecard, where the accounting smoke turned out to be a raging fire. The difference often comes down to the underlying cash flow and product demand. Supermicro's revenue growth has been explosive, triple-digit growth that most companies only dream of. The skeptics argued that this growth was pulled forward or aggressively recognized, which is the heart of the Hindenburg Research short report that kicked off this entire saga. The short report alleged channel stuffing, shipping products to warehouses just to book the revenue before the quarter ended, and questionable related party transactions involving suppliers owned by the CEO's family members. These are classic governance red flags. When you see related party transactions in a forensic audit, it forces you to question whether the costs and revenues are market rate or artificial. This is why the auditor's resignation was so damaging. It validated the fear that the internal controls were weak. Now the company has formed a special committee to investigate these claims. The outcome of this investigation is the binary event we are waiting for. If the special committee comes back and says, "We found some minor issues, we are fixing them, and here is our audited 10K," the stock could realistically double from these levels. The short interest is high, and a clean bill of health would trigger a massive short squeeze, sending those using Robinhood fractional shares or Fidelity IRAs scrambling to buy. On the other hand, if the investigation uncovers deep rot, or if they can't find a new auditor willing to sign off on the books, the downside is significant. Speaking of investing sites and tools, it's interesting to note how retail sentiment on platforms like SoFi Robo-Advisor or Robinhood Crypto Sections often correlates with high beta names like SMCI. There is a distinct fear of missing out, or FOMO, element here. Investors look at the chart, see the peak at $120, and see the current price of $33, and the psychological anchoring effect takes over. They think it has to go back up, but markets have no memory. The stock does not know it used to be $100. It only knows what the future cash flows are worth today, discounted by the risk. And right now, the risk premium is high sky. Comment below how many shares of Supermicrocomputer you currently hold and what your average buy-in price is. Are you underwater or did you get in early?